Hey guys, my name is LeClair. I'm head of research at Bitcoin Magazine, covering financial markets and OnChain Analytics. And I'm super pumped to be moderating a panel today titled OnChain Analytics: Signal versus Noise. So we got some experts, leading experts in the industry, and we're just going to sit down and have a chat today about OnChain Analytics and kind of dive deep. So. To introduce the speakers, on my right, I have Ki-Young Ju, CEO of CryptoQuant. I have Lucas Nuzzi. He is the network data lead at Coin Metrics. I have Wilfred, Daye, CEO of Enigma Securities, and I have Bhutoria, principal at Castle Island Ventures. So please give a warm welcome to these guys. So I guess to start it off, I'm going to ask Wilfred, who has a pretty extensive background on Wall Street, was working in mortgage-backed securities and structured credit before the financial crisis. Wilfred, I guess just for the people who don't know, what is OnChain Analytics, and why is it so unique compared to the legacy financial system? What are the key differences there?
Yeah, you're bringing up the very painful memories in the old days with CDO and mortgage securitization in the world, right? So this is truly the off-chain analytics of the world versus Bitcoin on-chain. When we were doing CDO business, for instance, mortgage and CDO business, we had to look at every loan. Every loan has cash flow, and the cash flow is computed off-chain, obviously, using something called PC farm. I'm sure a quarter of this audience does not know what PC farm was. It's basically a bunch of machines chained together on the server. And a lot of deal issuance, every deal is slightly different. The nuances are very, very different. So it takes a long time to understand a particular transaction. Every deal is different. So there's practically no transparency around how we look at deal analysis. And that's why you see in the capital market side, you have a lot of arbitrage in mezzanine, in equity, where those pieces matter most in terms of analytics from analytics cash flow perspective. Now the world is a little bit different. It sounds like there are folks out there doing on-chain mortgage securitization as well, which is quite exciting for me. Yep.
Yeah, I mean, it's pretty interesting. You're talking about on-chain, off-chain, just the transparency of the Bitcoin network, of the blockchain, being able to see capital flows. It's so unique compared to what we have seen in the legacy system. Lucas, guess going to you, many people are just kind of introing into Bitcoin. A lot of new entrants into the space recently. They're just looking at one thing and they're looking at the price. And while over the long term, price is the most important thing. It's the most important signal in the market. What are some on-chain metrics that you look at that you think may better measure the vitality of the Bitcoin network over the long run?
Yeah, and to echo what Wilfred said, you have like this crazy level of transparency on an aggregate basis, so you can see what users are doing as an aggregate, class. You can see the new entrants that are moving the price recently, right? You can see that the reason why Bitcoin has been highly responsive to Elon Musk's tweets is because the majority of people that are transacting on-chain right now probably got exposure within the past year or so, so their level of sophistication is different than the long-term holders that have held, some of which for years. So you see on an aggregate basis the behavior of different users, and you can actually look into the kind of steep learning curve of Bitcoin as a technology, just because the entities that tend to, especially in bull markets, move the market are the ones that probably in this particular situation bought in at 65 and now are reading Elon's tweets and selling at 35. And that cycle you can kind of observe on-chain. When it comes to active supply, for example, that there are new accounts that are doing that.
Yeah, what are you seeing what are you looking at when you kind of, this recent sell-off, you're saying it's all new coins or new entrants into the space. What are you kind of looking at? What metrics, what are those called?
Yeah, so there have been a couple of really interesting metrics to help inform the community at large, where we are in a market cycle. The one that I like the most, it's not the most sexy in terms of its complexity, but it's the most reliable, in my opinion. It's the ratio between market value, so market cap, relative to a metric that we created at OnChain Metrics called realized cap, which is analogous to the cost basis of the entire network, right? So if the cost basis of the network is pretty low and relative to where the market is right now, it might be a good indication that the market is a little frothy. And conversely, if the cost basis is pretty high relative to where we are now, it might be a sign of capitulation. So historically, you have these thresholds, when MVRV, when this ratio is below 1, it's a really good sign of capitulation. It's a good sign for you to start, for example, dollar cost averaging. And once 3.7 or so, it seems to be the historical threshold. Once that's crossed, is a good sign that things might be getting a little frothy. We didn't quite get to 3.7 in a couple of months ago when we hit an all-time high. We were flirting, I think, with 3.4 if my memory serves. So I don't think, looking at one metric can give you a full picture of what's happening in the market, but it's an interesting indication of local tops and bottoms. So it's one of my favorite metrics in that regard.
You mentioned there, Elon's tweets, and I'm sure everybody in the audience, has been following that to an extent. It's interesting in the Bitcoin market, 24/7, 365. It's not a security, so there's no insider trading. There's a lot of FUD, fear, uncertainty, and doubt being sent out there recently. I want to send it to Key. About 2 months ago, we saw there was a big alert that came out, that was pushed out, that there was a big transfer of Bitcoin onto an exchange, onto Gemini, and the price sold off, because the market kind of sees that as a sign that a whale, a big entity, is going to be selling if there's an inflow to an exchange. And it turned out to be mislabeled data, and the market just sold off for basically no reason. How do you think about the on-chain data and the potential misinterpretation of that, as well as just the exchange flows and what you guys do over at CryptoQuant?
So basically, on-chain data is not an exact science. Exchange inflows could be interpreted as a selling pressure, but it's getting hard to get signal from those flows because exchanges is now running, custody, staking solution, as well as exchange itself. So we're trying to find more granular signals so that by classifying those cold wallets that exchange custody is using and hot wallets that exchange user deposit wallets are connected to those hot wallets. So, and we're also trying to overlay market trading volume to exchange inflows so that those exchange inflows haven't executed yet on exchanges, on that kind of ideas. So I think our data was correct because it was exactly BlockFi to Gemini flow. It was not an internal transfer. So I think it's really important to get a signal by adding those advanced technologies to see more granular level of on-chain data. That effort is very important in this space to protect those misinterpretations.
Gotcha.
Yeah, it's one of the reasons why I said that you can't really look at one single metric and determine investment decisions on that single metric because all these blockchains, they're operating on a pseudonymous basis. You can see an address. You can't really objectively tag that address to an identity, to an exchange. So you have to rely on clustering methodologies to properly label them. And it's subjective, right? On-chain data can be your friend and give you supporting evidence of a market trend, but by misreading, for example, flows, which was exactly what happened, it can also be your enemy because a lot of people ended up selling on the basis of bad information. Right? The same happened when 2-3 months ago there was all this FUD around a double spend on Bitcoin, where people were freaking out that a double spend was included in a Bitcoin block. The market crashed 20%, but in reality, it was all fair game. It was a user that wanted to boost their transaction fees. Yeah. So there are so many caveats when you're operating under a pseudonymous system. It's really difficult to rely on a single metric to get objective information on what's going on.
Yeah,
go ahead.
That's definitely one of the limitations of on-chain analytics and on-chain data, right? Like, especially in the last few years, we've seen more traditional market participants enter and try and apply metrics that they use to analyze companies and traditional networks one-to-one to Bitcoin, and it just doesn't work. Like, one address does not equal one user. One user can have multiple addresses, and one address may be an exchange address that represents multiple users. And same thing with transactions. It's not one Bitcoin transaction does not equal one Visa transaction or one PayPal transaction. And it's really on us as stewards of the space to, publish as much content and reiterate that this is a completely novel network. And we can't, we have to apply caveats to the metrics that we use. We have to explain, why you can't apply it one-to-one to traditional network.
Yeah. I just want to highlight the fact that all the addresses in the world, they all change all the time. So OnChain Analytics is actually very dynamic, changes on a daily basis and second basis. So a lot of exchanges will switch their addresses and change their addresses all the time. And there are graphical models, there are sort of machine learning analytics models out there. They can sort of portray the big picture, but you need to be able to understand the story behind it. People utilize with your traditional trading, understanding of the capital markets, and be able to trade through that information in OnChain Analytics. Yeah.
That's a pretty interesting point about dismantling FUD with data, and in the legacy system, it's nowhere near as transparent as Bitcoin. So while it's actually it's one of Bitcoin's best features that it is completely transparent, auditable, and open to everybody. It's extremely easy per se to quantify Bitcoin's energy usage. And so I guess extending on that a little further, how do you guys think about the transparency of the blockchain and dismantling these common talking points that seemingly never go away year after year, cycle after cycle? How do you think about that? Really just open-ended.
One really frustrating FUD has been this idea of Bitcoin's energy cost per transaction. I think a lot of us in the audience probably know that miners expend resources and expend energy to earn the issuance reward, which over time will go down. And if you just do a really simple scatter plot comparing Bitcoin's energy consumption as measured by the CVECI relative to price, there's a clear relationship. But if you do it relative to transactions, there's really no relationship because miners are not expending so much energy to earn transaction fees right now. If you look at the composition of miner revenue, the majority of it is the block reward, it's the block issuance, and transaction fees are a really small component. And I think the idea is that over time, as transactions become a bigger component of miner revenue, it probably won't reach the same level it is now, but energy consumption will level out as well.
And that's by design, right? Satoshi, when they thought about how to distribute Bitcoins, the most fair resource, even in a fiat system, to determine how those coins would be distributed is electricity. Right? Right now, Bitcoin is likely overpaying for its security because of the block subsidy. Right. When you think about scenarios where Bitcoin could be attacked, it is so far-fetched at current levels, it's really difficult to even think about an attack scenario if hash rate were to fall by a third, or even half. So that has had an impact that's really interesting on-chain, this mechanism of distributing Bitcoins when it comes to supply distribution, right? One of the underappreciated aspects about proof of work and about Bitcoin itself is that it went through so many events in its history that led to supply turnover and ultimately made its monetary base, its users, a very democratic set of individuals, right? So a quarter of the supply is likely lost forever. And if you think about the Silk Road, if you think of everything that was happening in 2016, the block wars, all of these market cycles, there are several metrics that don't make the assumption that one address equals one user, but on an aggregate basis, if you're comparing all of these different crypto networks together, Bitcoin, because of that mechanism, has a really interesting distribution. It's a very democratic distribution.
Yeah.
So people think about electricity consumption and security spend mostly in terms of security, but it has had this massive impact in terms of distribution that is unique to Bitcoin.
Yeah. I think another common one is this idea that Bitcoin will eventually be replaced by competitors. But if you look historically at forks of Bitcoin or other coins that have tried to adjust the different trade-offs that Bitcoin makes in order to overtake it, like on pretty much any metric, Bitcoin is orders of magnitude higher. I was actually recently looking at the number of transactions that the Bitcoin network processes daily relative to Bitcoin Cash, and at a minimum, it's 5x higher, even though in theory it's supposed to process more transactions. So there's a lot of great data and way to use the data to dispel FUD, rather than having to go into this circular argument about, based just on qualitative metrics.
Yeah, in that sense, like almost price or market cap is one of the worst metrics when comparing altcoins versus Bitcoin. If you're looking at, Dogecoin or any of these altcoins compared to Bitcoin, the market cap may be significantly, skyrocketed in these Bitcoin bull runs, but the liquidity, the actual transaction volume, the on-chain volume, it doesn't really compare. I have a fun question for you guys. We obviously experienced close to a 50% drawdown recently. With all these on-chain metrics, we have some interesting cyclical, market top and bottom indicators, fuel multiple, market cap to realized cap, thermo cap to market cap, which is the aggregate amount of US dollar amounts that have been issued over the course of the entire Bitcoin network divided by the price. Where do you think we are in the cycle? How are you guys thinking about the recent price action? Is this a mid-cycle adjustment? A little more speculative, but what are your thoughts, Keith?
So I think MVRV Z-score is one of the best indicator to catch tops and bottoms. But I think things are changing on the blockchains because people are more holding Bitcoins, not it's for store of value, but it was for transactions, for years. So traditional indicators like MVRV could work, but blockchain transactions, the purpose of blockchain transactions are pretty different from over the years. So we need another indicators to catch tops and bottoms. One thing I've been looking at is that all exchanges inflow mean 7-day moving average. That's the average amount of inflows, exchange inflows for across all exchanges. And when this indicator spikes over 2.5 Bitcoins, the market is likely to be bottom because a lot of whales, they tend to sell their coins to exchanges, but they don't eventually sell them. That's what I interpret the data. So just visit CryptoQuant and search that indicator. You can see those spikes, and when those indicator spikes, the market price was bottom in the March gray sell of last year, 2019, February, and all those bottoms. So that's what I've been interested in.
I
Lucas, you were mentioning earlier, you were saying that you know of some funds that are using these metrics and literally trading off of them, certain ones. You want to provide a little more insight there or talk about that a little bit?
Yeah, no, absolutely. So there's been multiple metrics that are interesting to discern like where we are in the cycle. There are the caveats, right? I just talked about MVRV. Those thresholds were determined on the basis of three previous super cycles, right? I'm not convinced that we are close to the end of this, or this is the end of this cycle, because when you look into fundamentally what changed, there hasn't really been a whole lot of changes. You usually see, for example, a huge rotation at the end of these cycles where days destroyed, which is a metric that's interesting. It showcases the age of, well, it's a proxy to determine the age of sellers right now, and it usually spikes up when you have a whale that likely bought 4 or 5 years ago that's selling right now. We haven't seen huge spikes in that just yet, so it's hard to tell. There's always an interesting kind of liquidity culprit in these cycles. One interesting trend that we recently observed is the influence that a lot of these miners have on short-term liquidity. If you look into what's happening with the existing traders in the market joining, kind of this ecosystem within the past 12 months, they don't have a very systematic approach to trading, so they're going to be very reactive to news. That is compounded by the current enforcement actions that are taking place in China, where the CCP is cracking down on locally on all of these mining operations. There's evidence that miners have been liquidating and have been kind of the culprit of the last kind of push downwards. So I think fundamentally that doesn't really change the security of Bitcoin. I think it's actually one of the most positive developments of this year. I recently wrote about it. But I don't see a huge event, like we saw in 2018 when a lot of ICOs were selling their funds in crypto and converting that to fiat, and that was a massive driver of downwards pressure for prices. So there's not a single culprit this time around, which makes me dubious when it comes to determine whether or not this is kind of the end of the cycle.
Yeah, we hear a lot of talk about super cycle, and I think people kind of get the notion that that means price number go up every day, every single day, but rather that's more of a, we're in this phase of Bitcoin adoption where it's kind of, it's secular and there's more and more users constantly coming onto the network. How are you guys thinking about maybe the probability of a 4-year cycle? A lot of people link that to the halving. That's up for debate about how much the halving causes, but is there a chance that our very notion of cycles as we know it, kind of change? Wilfred, how are you thinking about that?
Yeah, so I think not to the 4-year cycle or the cycle is, we look at the distribution of the UTSOs. That's pretty clear. You can see folks who get into Bitcoin at a lower price, say sub 10,000. I think folks who get into a Bitcoin space, between 20K to 30K, and there are buckets of folks who will go up 40 and plus. So, we see some of the rotations and newcomers coming on a higher price level, whereas other folks being more OGs in the space and holding the asset much stronger. So there's definitely a baseline, there's support in the market that sort of a proposed, gave the hint of that 4-year cycle. But but it's, again, as you see more institution comes in, the cycle maybe 2 years, maybe faster dip. Maybe this time is a little bit different, right? So it's hard to gauge. But we also see significant stablecoin issuance recently. That also, the money flow coming from traditional USD and USD stables all the way into the cryptocurrency space. That itself will support, again, the higher level price triggers. So that's my view.
And just piggybacking off of that, I think psychologically these 4-year cycles and halvings definitely have an effect, but as we continue, the extent to which the block reward goes down as well, so it definitely has less of an impact. And then, just piggybacking off what Wilfred was saying, we've had such significant inflow from institutional investors and strong hands that have done their research. And I think Coinmetrics did an excellent post kind of identifying that in this recent sell-off prior to the China news, most of the coins that were selling off were in the 3 to 6 month range that were newer entrants to the market. So the stronger holders that have been around for longer, definitely that have conviction, aren't shaken out as easily. And I think that'll definitely dampen the impact of the cycles.
Yeah, how are you seeing institutional investors that come into the space? There is a steep learning curve, and I think unlike retail, a lot of these institutions kind of come in and move slowly. How are institutions approaching this asset and allocating to it? What are you seeing at Coinmetrics?
Yeah, I see not much of an institutional coming in, but more of a financialization of the Bitcoin ecosystem, to be precise. You have CME markets. You have folks like all the ETNs, ETF coming on board. Those are natural source of demand in the market, not only for institutional but also for retail. On the back end, obviously, you have institutional coming. You have service providers for some of the ETNs, some of the financialization or financial products. That's quite interesting. This is very different from 2017. When it's 2017, you never heard about ETN, never heard about all these financializations. Today we have those, and not only one, there are 20, 30 of them in the world. So this is quite exciting for folks like me.
Yeah, guys. So we got about 20 seconds left. So I think we're going to wrap it up here. Really had fun. Really had a good time with this chat. I hope you guys in the audience enjoyed, and give a round of applause to our speakers.